How's it going, guys? It is Dennis, and we're back with another video talking about YMAX and just YMAX, the YieldMax ETF, or the YieldMax Universal Fund of Option Income ETFs. We're talking about it today because today I want to talk about how many of you who are interested in YieldMax ETF, or you're looking at videos, or you're looking at tweets, and you just haven't clicked the button to buy, and you don't know which to select. Well, I feel like this is going to be a great video for you to understand why YMAX, in my opinion, not financial advice, in my opinion, will be a great choice for someone who's still on the cliff of, jumping off and clicking that button and deciding to choose a ETF from YieldMax ETF and start their high yield journey. Of course, these funds would come with their risks. Before I even get into anything, these funds have high risk. As much as people want to say low, mid, high risk, they all have high risk. These are new funds. These are new styles of trading when it comes to just overall the market. And they're constantly new companies putting new ones out, new strategies, new everything. So take this with a grain of salt when it comes to the safety of it. When you listen to other people, a lot of people will tell you that, YMAX is the safest. This one's not. Take it all with a grain of salt. But this video is just going to mostly focus on YMAX and why I believe, in my opinion, this should be your first fund you own before you venture into any other YieldMax fund or high yielding funds from other companies as well. So, starting off with YMAX, the distribution rate, 54.85%. That is your average distribution rate as of the previous distribution, which was announced this week on Wednesday. As of recording the video, this was yesterday, which was the 18th. Today's the 19th. I'm recording on Thursday. So, YMAX. What is YMAX? First of all, of course, if you're watching this video and you don't know what YMAX is a YieldMax fund that holds all their single stock ETF tickers. So, if we go ahead and take a look at their holdings, they have a bunch of holdings. They have exactly 30 holdings. Right? They have 30 holdings, which one of them is American government obligation funds. So we could technically say 29. It's 29 of their single stock ETFs, right? We have stuff from GDXY with Gold, Phoebe with Meta, ANSI with Amazon, GUI with Google, AMD with AMD, Palantir or PLTY for Palantir, Ybit for Bitcoin, PP for PayPal, Apply for Apple, SMCY, of course, for super microcomputers, Misty for MSTR, everybody's favorite, and of course CVNY for Carvana. All their single stock ETF tickers are in this fund. That is why I say that this is a great fund for anybody starting off with high yield dividend ETFs. Anybody looking into YieldMax ETFs specifically should start off with YMAX. It has all the ETFs. Why choose which one you want to buy? This is the same way you have old school financial YouTubers and social media influencers who tell you, don't buy a single stock, buy just the S&P 500, buy the QQQs, right? Buy VOO. Don't buy a single stock ETF. This is the same example right here. Why choose a single stock ETF, especially when you're new in the game? Just choose the YMAX. It holds all of them, and it pays weekly, and it has good dividend returns, right? It takes the dividends from those single stock ETFs from every single week, from every single group, and pays you every single week for every single group. And you get distributions rate like this at 54.85%. And you get dividends like this, where you have 18 cents, 17 cents, 21 cents, 18, 19, 16, 17, right? We had lows of 13 and 13 and 12 over here, but roughly we're staying around the 18s and 20s. Sometimes we dip low, sometimes we go high. It varies. It depends on, of course, the return of those single stock ETFs that are held, right? Dividend yield currently is at 60.77%. And of course, the dividend is not updated. This is from last week's dividend. So if we were adding this week's dividend, it would be lower, because I think this one came in lower for this week, if I'm not wrong. But we currently have a payout of $8.20, and we've lost roughly $7 in value from the share. So not including compounding, not including buying times, you would be up only $1.20 if you're looking at just value loss to dividends gained. But of course, there's compounding, there's purchase times and purchase events, right? If you're purchasing at bottoms, of course, if not timing it, but just let's say it happens to be you purchased at the bottom with your dividends reinvested, you would be in a better scenario than just having those dividends. But even if you just did have those dividends, you would be still up on your total return. So, YMAX, but why not YMAG, you might be asking? And why not pick ULTI? Why not pick LFGY? Well, we could look at the charts, right? So, YieldMax ETF, a lot of companies now are releasing weekly paying ETFs. It's a big thing now. People don't want to wait a month. They want to have their ETFs weekly. They want to have their weekly checks. They want to have their weekly compounding, and therefore companies are providing that. Looking at the charts, just focusing on YieldMax weekly ETFs, YMAX outperforms at 14.54% in a 1-year chart. The S&P returns 9%. YMAG returns 11.51%. So that's the Mag 7, right? YMAG, Mag 7s ETFs. They hold their single stock ETFs as well, but it's Mag 7 based. So Tesla, Google, Amazon, everything of that sorts. ULTI is, of course, their little game that they play on ULTI. It's a weekly paying ETF. Well, it just changed, not too recent, into a weekly paying ETF. And this one has had terrible NAV erosion, but they are able to play around with ULTI a lot, choose whatever they want to choose. They're not limited to a single ETF or a single strategy. They can play around, make money, make income, and pay that out to you. And they've returned 11%, similar to YMAG, but a little bit under. LFGY is a recent one. So when we look at the 1 year, it did have less time to play around, less time for reinvestment, less time for growth. And it's sitting at negative 0.67%. We also have GPTY, and that one's at 6.31%, surprisingly, but still lower than YMAX at 14.54%. And then we do have one competitor, Chippy, or CHPY, which focuses, of course, on chip stocks, and that one has returned 26.39%, higher than YMAX, but it has had almost, like, what is that? So when did this start? This started around 2025. What is that? April? Yeah, around April time. So around April time of 2025, it had a little time to really show us data and give us data on how it would perform in the long term. So take it as it is. Take it with a grain of salt. There's still a lot of data and still a lot of time for us to really see how good Chippy is on a long-term scale. But we have YMAX, which shows that on a long-term scale, it could provide us 14.54% return. Look at a 3-year, 31.41% return. S&P 58.86. So, of course, it also had less time than S&P to go ahead and grow and have that return, but still 31.41% since inception of 2024 is pretty darn good. So, we see that this is, in my opinion, the best weekly yielding ETF out of all of them. Beats YMAG, the Mag 7, beats ULTI, also is way more diversified than YMAG, because Mag 7, only 7 ETFs. It beats ULTI, which you don't even have we technically do have diversification, but it just depends on the week of the month of how they decide to trade. It's beating LFGY, it's beating GPTY, and it's beating Chippy. Well, it's not beating Chippy currently, but in the long term, we'll see if it'll be beating Chippy. But it is beating GPTY, it's beating LFGY, ULTI, YMAG, and S&P. That is why, out of all the weekly ETFs that YieldMax has to offer, YMAX is my choice. Just based off the straight data from Alpha Seeking Alpha, for anybody can search this up, 14.54% total return. It just is a no-brainer for me. But you might be thinking, why would I choose YMAX? Why would I listen to the basic investing advice that everybody gives? That, like I mentioned before, buy VOO, buy the S&P, buy the QQQs, don't pick single stock ETFs. No, Dennis, I want to take single stock risk. I want to invest in single stock ETFs because they have great returns. And I don't disagree. They do. We could take a look at the charts. YMAX, like I said, 14.54%. Misty, everybody's love and great ETF Misty, 103.26. Tesla, 25.11%. Even though this one hasn't been the greatest, it's still 25.11%, almost double of what YMAX is. PLTY, 129.34%. NVIDIA, 5.81%. So you can see it varies. So 5.81% from NVIDIA. This is NVIDIA-based single stock ETF, and it's yielding 5.81%. 2 times lower than YMAX, almost 3. Phoebe with 31.46. Nefli, 67.07%. And now I'll be showing you this, and you might be saying, well, this just disproves your whole point. I could just choose one of these ETFs, single stock ETFs, and I'm set, right? I'm set. But let's go ahead and take a look at something for a second. Let's go ahead and click on Tesla. Right here, Tesla peaked in 2024 of December, and it was yielding at that point 73%. Now let's take a look at what happened with Tesla. Looking at the chart, it started to trend downwards. The reason why it started to trend downwards is because the underlying stock trend downwards. These single stock ETFs are only good for when there is constant growth. When there's just constant growth for a year, for 2 years, no matter what the time frame is, they do amazing when they have that constant growth. They will underperform their single stock ETFs. They will underperform, but they are not meant for long term. They are not meant for long term. The good thing about YMAX and its 14.54% return is you're not dependent on one underlying stock or one single stock ETF. If one underperforms, so say Tesla or Nvidia are underperforming, we have Misty and PLTY to win it for us. Say Misty and PLTY start underperforming, and then Phoebe and Netflix are continuing to perform good. They will continue to save our portfolio and continue to save our income for YMAX. YMAX has hedges. YMAX has safety, right? You have different sectors. You have different underlying stocks. One goes down because maybe tariffs. Another one goes up because of tariffs. Another one goes down because of free trade. Another one goes up because of free trade. We have different ETFs with different underlyings that move due to different news and different economical outputs and just inputs, right? That's the great thing about YMAX. And we could go ahead and take a look at that as well, right? So we're looking at Netflix. Netflix returned to 67.07%. Looks great, right? Look at Netflix on the 1 year, 78.97%. Look at that. Just trending upwards, up, and up. Just continue to trend upwards. Gave us 78.97% return in a year if you bought. And Netflix gave us 67.07%, which is quite close to what Netflix returned. Let's take a look at another one. Phoebe, 31.46%. How does the meta chart look on a 1 year? Same thing, 38.51%. Look at the Phoebe return, 31.46, very, very close. And look how it trended. It trended up and up and up. And of course, we had this little drop over here for quite a bit of time, and it started trending back upwards. If we take a look at the chart once again, we can see that, right? We see this drop right here, the peak. It drops back down and starts trending back upwards again while the stock trends upwards as well, right? Take a look at PLTR. Look at that, 428% return on the 1 year. 428% return on the 1 year. Beautiful returns. Let's go ahead and take a look at PLTY. 129%. Underperformed quite a lot. But that's just because they're not able to capture all of it, right? Covered calls, you're not able to capture it. But just showing you, I'm just trying to show you with this. MSTR, same thing, 150% return on the 1 year. MSTY has 103% return. This is just to show you that yes, these single stock ETFs can be lucrative and give you high returns, and they're amazing, right? I don't doubt it. A lot of people are making a lot of money off Misty. A lot of people are making a lot of money off PLTY. A lot of people made a lot of money off Nvidia before it had the little drop, right? Before it had the drop, right? Phoebe, Netflix, same thing. But these ETFs only work if that underlying stock continues to trend upwards, and it has to trend upwards constantly. If you have drops, the ETF will drop, and it'll be hard for it to recover. It will not recover as fast as its underlying, right? That's just how these ETFs work. So you have to choose an ETF or an underlying stock, an ETF with an underlying stock that you believe will be bullish on the long term, and it'll be consecutively bullish, right? It'll constantly go up. But at the same time, you want there to be volatility, right? You want it to go up, but you want it to be their volatility as well. So preferably you want that volatility to be on the daily or weekly basis, right? So daily basis would be preferable because you have weekly trades on single stocks, right? So you have weekly trades, but you have daily movement, right? So you win on the week, but you get all the volatility on the daily, so you make a lot of premium, but it still trends upwards. That's what you want from these single stock ETFs. But guess what? With YMAX, you don't have to worry about that. YMAX, of course, volatility affects YMAX because if the underlyings that it holds, which are the single stock ETFs, lose volatility, their underlyings lose volatility and lose premium income, then YMAX will be affected too. Yes, of course. But YMAX, like mentioned before, has diversification on its side. That diversification gives you the ability and that safety. Like I said, they're still high risk. These are still high risk assets, but it gives you that safety compared to single stock ETFs of there being other single stock ETFs that could hold up your YMAX position, that could hold that dividend every single week that it gets, and you'll always have somewhat consistent income, somewhat consistent growth, as long as there's some of that portfolio that is growing while the other portfolio might be not performing so well, right? Now, if the whole market's tanking, it's going to tank with the market. But what we saw in the first charts, right? We saw that it beats the S&P, which is at 9%, and YMAX is at 14.54%. So that is fundamentally why I believe, in my opinion, not financial advice once again, in my opinion, YMAX should be your first YieldMax investment. If you are not invested already, should be your first YieldMax investment. And if you watched my previous video from last week, you would know that it should be your first base investment. It should be your base to your portfolio if you're a high yielding dividend investor, not if you're long-term growth orientated. I'm not speaking to you. If you're a high yield dividend investor and you have Misty, right? Or you want to buy Misty, you want to buy PLTY, you want to do options trading, you want to take high risk and get high reward from your investments, you need to have a base, right? If it's not cash, if it's not a lot of stockpiled cash, if it's not bonds, right? Or if it's not safe positions or safer positions, right? Like SPYI or QQQI, if that's not what you're into, it should be YMAX. YMAX has consistent returns. It's diversified, and it's weekly. You lose a little bit one month, or say there's an opportunity to buy one of these single stock ETFs like Misty on one of the weeks, you have income to buy it. You lose an options trade, you have to pay back something, or you just don't have any money to continue options trading, you have weekly income. That's the beauty of YMAX, and that's why I had to make this separate video for you guys, because I see a lot of people on the Reddit, on the Reddit, the YieldMax ETF Reddit, a lot of people on Twitter just going full Misty, full PLTY, and just booking it into that. And I understand. It's great, right? 100% returns, right? And it's giving you $3 or $4 per share. But listen, as soon as those premiums start getting lower, as soon as there's a dip in those single stocks, which I hope there isn't because I want people to continue to make money. I'm not hoping for the worst. I'm not being a bear. But there will probably be a moment where those stocks will dip. And it'll do a bit hard, and they'll go into a short-term bear market, or maybe a long-term bear market, or a bear moment for those stocks. And that will be not a good time for a single stock investor who has majority of portfolio invested into Misty, PLTY, and all these other ETFs. And sure, you can make the claim that you would make your money back in a year or less if you hold PLTY or MSTY, like many people have done. But now it's not guaranteed. Now it's all FOMO. If you bought in the beginning, sure, I don't disagree. You probably made a lot of money in the beginning of MSTY and PLTY. You probably made all your money back if you didn't reinvest, right? If you reinvested, you probably made more, but then also it would take a lot more time to make all that money back. But if you're buying now and you're looking to YieldMax ETFs now, or any other high-yielding ETFs that are based on single stocks now, I would highly advise starting off with a safer position. If it's not YMAX after watching this video, of course, it's not financial advice for you to do so. This is just what I do. I have 14% of my portfolio in YMAX, right? And another 14 in QDT. So I'm a strong believer in weekly paying ETFs that are based off the overall market and are diversified, right? If that is not your first choice, then I hope you decide to choose something like SGOV for bonds, just a cash position, or SPYI QQQI. Because in the case, there's hard dips down on PLTY and MSTY and all these other ETFs. It's going to be a rough time for you to recover back. It's going to be a long, long journey. And if you're not willing to wait, like I personally have with Tesla, because I bought Tesla when it was, up high and it was doing great. I bought in the beginning and I've just been waiting. But I have that time, I have that tolerance to wait for my money to be made back and continue to reinvest to continue to lower my average cost. If you don't have that time, if you don't have that grit to get through that period, I highly advise not going straight into Misty, PLTY, or any other high yielding ETF that's giving you 100 plus returns, plus percent return, because that means it has high volatility with the underlying, I highly advise looking into other safer alternatives. One of them being, in my opinion, and something I go into, YMAX. So just had to put that video out there because I've been seeing a lot of talks about Misty, a lot of talks of PLTY, a lot of people retiring. You know, apparently 2 months into retirement is a great achievement. You know, give it a year. You know, I'm not saying you shouldn't retire and you shouldn't use these funds, but give it a year. If you're still able to make consistent income and continue to keep that same amount of income, then sure, you're officially retired with a safe plan, right? Safe plan. Of course, the safest thing to do, as many others say, is bonds or cash. You know, anything that's consistent, right? That's the safest. Even then, who knows what's going to happen in case bonds might not work out. But just saying, you know, that's safe. Bonds. But, you know, this is not a video about bonds. It's a video about YMAX. And anyways, I'm not going to stop ranting. I'm just going to say thank you for watching. Thank you for liking my videos. Thank you for subscribing. And I'll see you guys next video. Hopefully Misty and PLTY do not go down under. Hopefully I'm not the one who called the storm, or said, what is it called? I don't know, I'm blanking out on it, but whatever. Knock on wood. Thank God my desk is wooden. I can knock on wood, and hopefully it does not happen in this week time frame until next video. But anyways, I'll see you guys next video. Enough ranting for me. It's been Dennis. Thank you so much for watching. Goodbye.